I don't want to take all of your time, but best of luck in your second presentation, and we're so grateful for your knowledge and being such a brave risk taker for presenting to all of your teachers and helping us. So thank you.
Okay, hello everyone. My name is Nene. If you didn't know that already, since I have seen some new faces, this is the second week, and today we'll be covering the difference between value investing and speculating. So, here's a disclaimer before I start. I've been learning about this over many course of years of my life. I cannot possibly fit this into a tiny amount of 30 minutes. So, I'll try to then most of this will be oversimplified, but you will get the main idea. I won't be going into any details, so just so you know, maybe do a little bit more research after this, because I will not be going into details. So, first off, we'll be covering how value investing and speculating is different. When I was a kid, I obviously didn't know what an investor is. And my teacher asked, "Hey, what does your dad do as an investor?" I did not know. So, I said, "He trades stocks in the market." Trading and investing is very different, so I'll be explaining to you with an example used for me, the story of an apple farmer, everyone. So, imagine you're an apple farmer, and, well, you want to open an apple business, right? That's your business. You invest $1 million into buying supplies, the farmland, the apple seeds, whatever. And it's going pretty well. You earn 100,000 baht yearly, and 100,000 baht times 10, that's 1 million, right? So you break even on your initial investment in 10 years. So, imagine you have a neighbor who's also an apple farmer, and they desperately need money. So they sell their whole business, their entire business, for 500,000 baht. This is about 12 years after you start your business. So, if your neighbor sold their entire business for 500,000 baht, that might mean your business is also worth 500,000 baht. Would you care if your business was worth 500,000 baht?
Yes.
Well, you shouldn't, but I'll tell you why later. So, first off, hi, hello again. So, before we get into that, I'll be telling you why our privately owned apple business, which we'll be using as an analogy, is not that much different from listed companies in the market. The only difference is, well, it's the same thing, right? It's a business. You sell stuff. The only difference is your apple business is 100% owned by you, and your listed companies are owned by very, 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 very many people. This is why you shouldn't care if your apple business is worth 500,000. It's because it doesn't interfere with your earnings. If they sold their land for 500,000, you're not in the business of selling land. You're in the business of selling apples, right? So why should you care if the plot of land next to you suddenly decreases to 500,000? It just doesn't affect your earnings. You're earning 100,000 yearly, right? So let's use an analogy with stocks. So imagine if you own Microsoft stock, and it still earns steady income, and then suddenly everyone in the market starts panic selling. Would you care? Like, should you care? Because fundamentally, it's still earning pretty well, right? And you know it's a good company, so should you care if the price goes down? You shouldn't, because fundamentally it hasn't, fundamentally the earnings are the same, right? And if you're still earning steadily year after year, and you're not losing money, you're still earning steadily, fundamentally the stock is still great. Well, you should really care, because valuation of a stock is different from person to person. I'll explain that later. But if someone sells it low and it's still fundamentally great, you should really care, I guess. Does everyone understand? Do I need to clarify? That was a really bad explanation.
No, that's fine. Trying to get the grip of it.
So it's essentially the same thing. But many people in the stock market, when they see the prices are going down, they panic sell. That is exactly what you do not want to do. should be buying, but I'll get into that also later. So, in investing, going back to our analogy, you're in the business of selling apples. You expect to get dividends from your profits, and you're earning steadily year after year after year. And when you invest in a business, you're the partial owner of that business, and it generates reliable, recurring income. However, when you're speculating, and if you're like the people who panic sale, you're in the business of trading farmland. So that's our analogy. Maybe, okay, your neighbor sold it for $500,000. Everyone else in your neighborhood that also owns apple farms and are not investing, they're also going to panic, and they're going to sell it for $400,000, $300,000 if the prices keep going down, 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 down. Because they're not in the business of selling apples, they're in the business of selling farmland. It's very different. They expect to get capital gain from price growth. What was I going to say? And your apple business is gone once you sell it. It's a one-time deal. You don't get dividends because speculating is usually done on a day-to-day, week-to-week, hour-to-hour basis. It's very short-term. So, as long as the company is earning fundamentally, there's nothing wrong with the company, lower stock prices shouldn't affect your cash flow. It actually might be again, once in a lifetime opportunity. I'll get back into that later. So calm down, do not panic when stock prices go down. It's a crisis, it happened many times before, you'll be fine. As long as you keep getting dividends and earning steadily, you'll be fine. So, okay, now, imagine you want to own a coffee shop. You invest in $1 million for raw equipment, raw material, rental fee, etc., etc. And since you're, opening your own business, it's risky, right? You're going to have to take on that risk. But luckily, your coffee shop becomes pretty successful. And the future looks pretty great. You generate a profit of $100,000. And I'm going to ask right now if any of you need clarification, because I don't want to move past this if you don't understand. So the big question is, since the future is looking very bright, someone wants to buy your coffee shop. How much would you sell your coffee shop for? And how do you come up with that number? So, everyone, would you sell your coffee shop for $1 million?
No.
Why?
Because you've already invested $1 million.
And you're making $100,000 a month already.
Exactly. How about $1.2 million?
Are you making $100,000 bottom month or a year?
A year.
No.
1.5?
Yes. Because then it's less risky. You've already profited 400,000 baht.
I'm fine like mine.
I'd probably sell it for $1 million.
But I would say that's the question. How do you come up with the number?
We'll get into that later.
Don't know how to calculate the number. But definitely, if you started with $1 million, you want to make a profit.
How about $2 million? Would you sell?
I would still no.
Okay, that's fair. How about you guys? You've been very quiet, so I feel the need to reach to you.
If you want,
5 million, maybe, yes.
depends if you want to get like
I
a
think
lot of money, or just
Depends on if you keep growing and your risk or not, like how much money you want to sale.
What? I'm sorry, my brain.
Would it then depend on if you wanted, how much money you wanted to sell, if you can handle the risk of all that stuff?
Also, maybe how passionate you are about it. Like, if you
there's many
really
things
love coffee and you want to be in the hospitality industry, you like food and beverage, then that might have a big factor in it. If you're doing it purely just to make an earning, if you sell it for anything more than what you paid for, plus the revenue it would generate, you'd be doing well.
some profit there.
Yeah, so you see how everyone gave different answers? That is why stock prices go up and down in the market. No. Even if you have the same business with the same earnings, everyone's going to value it differently. So that's why the stock prices go up and down, constantly. So suppose you're willing to sell your coffee shop for $2 million. Disregarding other numbers for now, because this is the easy number. Are you willing to sell 75% of it for 1.5?
No.
Why not?
Because you don't own it.
What?
You don't own it. You lose control of the interest.
You'd be part owner.
You'd be part owner, yes. Like you tell 75% of. I don't understand your.
But you still need to work with your partner, right? So you
Yes.
have to then listen to maybe, depending on what the agreement was, you'd likely have to, work with them to collaborate and listen to what their ideas might be about the coffee shop, what they want to put into it for different factors, marketing, repairs, staffing, it's another person's voice.
I was gonna get into it, but I feel like we've gotten off track. So this is just showing it's proportionate, right? Because 1.5 is 3 over 4 times 2 million. It's just proportionate. So I'll get into that why. Oh dear. I'm sorry, I just came from class. We'll get into why that's important in 2 slides? So, before we do any of that, this is the price to earning ratio. This is the basic method of how people value stocks. So the price is the price you paid for the stock. And the earning is, the profit the company generates per year. The PE ratio basically indicates how many years it would take for you to make back your initial investment. So imagine if you sell your entire company for 100%, your entire company for $2 million, and you earn 100,000 baht a year, correct? So your PE would be 2 million divided by 100,000, that would be 20. This interpretation is, if you buy 100% of the company, it would take you 20 years to make back your initial investment. Given that the yearly earnings are constant, that's going to be important later. Oh, that's 16 minutes, okay. Do you think it would change if the price, if you only sold half of your company? 500,000. Without looking at the slides, please. That's cheating. Would it change? I'm seeing a shake of my head. What?
Absolutely wonder.
Well, not necessarily. Since you only bought half of the company, obviously you're not going to be taking all the profits anymore, right? It's going to be reduced proportionately. So if you bought 500,000, 25% of it for 500,000, your proportions are also going to be smaller. So you're going to only get 1/4 of the company, so that's 1/4 times 100,000. That would also equal, that would be 25,000. So it'd be 100,000 over 25,000, and it's still 20. So this is just to show you that no matter how much you buy, it's still going to be proportionate. So it doesn't matter if you own the whole company or even 0.01% of it, earning allocation will always stay the same. Essentially, if you own Microsoft, 1 share Bill Gates owns is also 1 share you own. And the earning allocation stays the same. You know the difference between us and Bill Gates?
Yes, a lot more.
Yes, Mr. Simon! Yes, and correct, he is also very rich. There's also a few differences. His price was much lower because he started his business without even knowing it was going to succeed. So no one obviously put any value in it. His earnings were also a lot much lower. Again, he was a small company. He wouldn't have any income, honestly. So his PE, the PE back then and the PE now wouldn't be very much comparable. So when he bought Microsoft shares, or when he made Microsoft back then, when no one knew what Microsoft was, and when you buy it when everyone in this world does not know anyone who doesn't know what Microsoft is, obviously the person who took the higher risk is going to get higher returns as well, right? PE ratio also has its own limitations. What if the annual earnings keeps increasing every year? Obviously, the PE ratios this year is not going to be applicable next year, right? How about if it keeps decreasing? Increasing is a plus, because at least you're earning more money. Decreasing, however, is going to be a problem. So, I'd like you to think, how do the annual earnings affect the PE ratio?
So if it's decreasing, right, then the PDE ratio is going to also depreciate too. It's going to go down.
Well, no, you have to remember, oh, there's no whiteboard. Okay, this has P, this has E. I do not have a whiteboard, so please bear with me. So, imagine if the price is 4 and down here is, let's say, 2 originally. If your earnings decrease, so from 2 to 1, let's say,
Okay.
from 2 years, because 4 divided by 2, that's 2, right? It's going to be 4 over 1, so that's 4. You're going to have to wait a longer period of time if earnings decrease. And same goes for the opposite. And they eventually affect share price because most investors are going to look at a higher PE ratio and go, oh, I don't want to wait that long. But when PE ratios are low, and maybe the price increase or the earnings increase, they're going to be like, oh, I really, 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 really want the stock because it's really worth it, and they're going to buy more of it. And then eventually the price is going to increase, and then it's going to be put back in balance. Does that make sense?
Yes.
I'm very worried about explaining this properly. Does anyone have any questions for now? So, here's another problem. How do you know if a PE ratio is appropriate? How does one know if it's a good PE ratio for a company?
The lesser the P number, the better.
I guess it would. So it's like Ferrari. Imagine you want us to buy, there's a Ferrari, and it's priced at $1 million. How do you know that's super, super, very, very, very dirt cheap?
Because you know the cost of Ferrari
Yeah,
would typically sell for a lot higher.
High-end brand.
How about for a BMW? How do you know that that's kind of cheap? $1 million.
Because BMW is still a reputable brand, maybe not in the same category as like a supercar would be, but it's, you know, still a luxury brand.
Do you know what BYD is? I'm not sure if you guys. Okay, I'll change it. How about a Toyota? I don't know. How do you know that's just kind of appropriate?
Because usually you would see the advertised price, or you'd be able to compare it because you see it, in advertisements or word of mouth. Yeah.
I would just compare it.
Yeah, that is exactly what you kind of should do.
Yeah.
Since you know the pros and cons of each car, you kind of know what is appropriate for it, right? Same goes for PE ratio. You need to be familiar with the company's products and services to think, oh, imagine there's a bread company. I don't know what's an example right now. And it has a PE ratio of 30. Based on other companies around it and its products, is it worth it? You kind of have to compare, if you understand. You also have to be familiar with its enemies, so you can also compare the company's PE to its enemies. While numbers and financial statements and everything is important because you don't want a company that's going into debt or anything, your gut is also very important when it comes down to decisions between two stocks that are essentially very, very similar and also have very similar PE ratio, like very similar PE ratios and stuff. So, when investing in the stock market, look for a deal that makes profit from the moment you buy. Basically buy a Ferrari at the price of a Toyota. It comes by very rarely, but it does happen. I've seen it with my father. This kind of opportunity only comes by when it's like a huge panic sale in the market. I'm assuming you've heard of it like in the news sometimes. You also have to check though, if that stock is so good, why is the price so low? Sometimes there are instances where that stock has a scandal, or maybe there's like the earnings are decreasing, you also have to check like what's going on. Just don't buy when stock price. Don't buy a Ferrari when it's a price of a Ferrari, mostly because it's expensive and you probably can't afford that in the long run. There's also no profit to be made from the moment you buy it, so it's not really worth it. Instead, you should just kind of wait. And it does come by. So, the wealth from high capital gains is kind of more like an illusion, because you know how stock prices go up and down every day? It's like you're getting rich today and then very, very poor the next, and then super rich today and then somewhat rich the next. It's not very, you're not getting that money unless you sell that stock. So it's more of like a kind of just there. And wealth from steadily recurring earnings year after year. So your dividends, that's real, because you can use that to buy more stocks, which increase your percentage of the company you own. So like it's a bigger piece of the pie, so you also get more dividends for that. So you can use your dividends to buy more shares, and those shares will generate more dividends for you, which you can in turn use it to buy more shares, and it's going to be a big, big cycle. Hi, Mr. Rich. So repeat this process each year, and you will have a really steady kind of passive income. It does take research. Yeah. Do you have any questions?
Great job. Yeah.
Sorry, that was like very good. Very good.